Hi everyone, thanks for attending this webinar today. Before we continue any further, can you please confirm in the chat if you can hear me okay, loud and clear, and if you can see the presentation and the presentation only. Okay, perfect. If you can hear me, then it's fine. If it's too loud, then let me know. If it's too quiet, then let me know as well. The thing is that today I'm doing this webinar from a completely different location as usual with a different equipment. So I will also be directly to the point, just try to keep it short and informational, and I do apologize for any background noise you might hear during the webinar. Okay, so while we let the vast people connect, let me just go through the disclaimer for you quickly, so bear with me. Contents of this material are provided by third party, not hot Forex, and are for informational purposes only and do not constitute investment advice. Hot Forex and Blue Sky Binary assume no responsibility for any potential errors, inaccuracies, or omissions in this material. Nothing in this communication or contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of purchase or sale of any financial instrument. Any views or opinions presented within this material are solely those of the author and do not necessarily represent those of Hot Forex unless otherwise specifically stated. Currency trading may not be suitable for all investors as it carries a high degree of risk to your capital. Trading just products is risky and you may lose all of your investment. Past performance is not indicative of future results. Poor fill rates, expiry times, market volatility, and platform errors could result in losing trades. Before deciding to invest in currencies, you should carefully consider your investment objectives, level of experience, and risk appetite. You should be aware of all the risks associated with foreign exchange and currency trading and seek advice from an independent financial advisor if necessary. So with this out of the way, today we'll be going to discuss Fibonacci trading and how to implement it in your daily trading activities. So I'll quickly introduce myself. We'll talk about the main two types of markets that you will encounter. We'll then discuss the Fibonacci theory in a bit more detail. And then, of course, how to use the Fibonacci to trade FX. Of course, stop loss and take profit management, and as per standard, we'll have a Q&A in the end. So please write down all your questions that you might have during the webinar and ask them in the very end. I'll do my best to answer them. So I am one of the members, one of the senior traders of Blue Sky Forex, which is a part of Blue Sky Binary. We provide 24-hour support and trade analysis to now binary option and FX traders to trade safer. Blue Sky Forex is presenting this webinar on behalf of Hot Forex in order to educate you and help you become highly profitable currency traders. So let's take a look at two market types you will encounter. One of them is price action, aka trending market, and the other one is mean reversion, aka a ranging market. Now, price action tends to be more powerful because a proper trending market is fueled by significant news that has hit the market and makes the price significantly move towards one direction. It is a bit more difficult to identify as you have to understand what is actually making the price move. If you notice some news being released, some economic news, you need to understand the magnitude of that news and how what is the impact on the market. If it is significant enough for the trend to continue, or it might exhaust quickly and reverse. Mean reversion, it is definitely more common market, and it is definitely easier to identify as well. In terms of Fibonacci retracement, we will be focusing on one certain type of Fibonacci tool, which is the retracement patterns. And these can be used on mean reverting markets, definitely. But to my personal experience, a trending market plus Fibonacci retracement tool is a bit better combination and can yield higher returns. So what is the Fibonacci theory? It's really simple if you get your head around it. Essentially, there are the Fibonacci numbers, aka the Fibonacci sequence, and the sequence goes like this: 1, 1, 2, 3, 5, 8, 13, etc. As you can see on the top left side. Now, how these numbers are manifested into the sequence is that each next number is the sum of the two previous numbers. Okay, so as you can see, let's take 1. 1 plus 0 is 1, 2, 1 plus 1 is 2, and 1 plus 2 is 3, 2 plus 3 is 5, etc. So really straightforward, really easy to understand. And what is really curious about this sequence is that this manifests all around us. Within us, in nature, you can see bee procreation patterns, you can see flower patterns based on this sequence, and of course other biological systems. And it's really mysterious because nobody can really say why this Fibonacci sequence is found everywhere. So this was discovered by an Italian mathematician, Leonardo Bonacci, in the 13th century already. However, its origins are more way back in the past in Indian mathematics already. Okay, just very brief introduction what the Fibonacci theory itself is. And now, I would highly recommend actually looking into this Fibonacci theory more thoroughly. There's a lot of interesting and fun facts about this as well if you are interested. However, now Fibonacci in FX trading, there are several different types of Fibonacci indicators. In MetaTrader 4, an example, we're talking about the Fibonacci arcs, Fibonacci fans, time zones, but this webinar is specifically about Fibonacci retracements because the retracement tool is the most commonly used Fibonacci trading tool, and I think it's even the easiest one to use. Okay, so the Fibonacci retracement tool can be used to find potential price levels after a certain movement, where the price might retrace to. Okay, so it's manifested as percentages of the price move. Okay, so full retracement is a 100% move, and half point retracement is 50%, and so on. So as I said, to me personally, using this Fibonacci retracement tool is better on the trending market, as it can yield a lot higher returns as you would get during a ranging market, because the ranging market is usually not ranging within, of course, on a higher time frame, it definitely can be ranging within 200 pip range, an example. But if you are really a day trader or even a scalper, then the prices usually are ranging within 30-40 pips range. And then in this case, using the Fibonacci retracement and its principles will yield a bit lower profits than if you would use it for significant trending markets where the price has already moved for 100 or 150 pips. Okay. So before I show a picture on the next slide, how to draw the Fibonacci retracement tool and how the levels show up on the chart, there are a few key things to keep in mind, and basically you can apply this into one simple trading strategy and simply trade it. Okay, so keep the following points in mind. If there is a certain 100 pip move or a 100 pip drop, as you will see on the next example, during the main trading session, main trading day, we're talking about the London and the US session overlap. And if that news is, or if that move is driven by major news, then it will at one point create a very useful and very good retracement opportunity for the price. You'll definitely see this on the picture that I will show you next. If you want to trade this retracement of that significant larger than 100 pip move, then I would recommend to start searching for these entry opportunities past 5 p.m. GMT after the London session, after the London market closes. Then you have a bit of increased probability that the price will retrace upwards to at least to the very first Fibonacci retracement line. So what you do, you use the Fibonacci retracement indicator or tool on your charting platform. MetaTrader 4 has this. It's really easily accessible. And what you do is you draw the Fibonacci line from the peak before the drop and to the very low point after the drop. Now, how to determine what is the minimum or the very low point after the drop is you'll start seeing some exhaustion setting in. You'll most likely see some reversal and candlestick patterns like dojis or hammers. So as you can see, some exhaustion setting in. As you see, the price actually bouncing off at the very low point of the move. Then you can start looking for trading opportunities going along towards the very first retracement level. Okay, so your take profit can be a bit further than the very first Fibonacci retracement level. I wouldn't really recommend to set it exactly onto that level because, as you know, it's just like with support and resistance levels. It's really rare for the price to bounce directly off that level. Usually it moves past that level for 2-3 pips perhaps before it actually reverses. Okay, before the support or resistance level repels the price. Same is with these Fibonacci retracement levels. They act as significant support and resistance levels, so the price can move a bit further past these levels and then bounce off. Okay. The next example, this example is for a large bearish trend. It works exactly the same way for a bullish trend if the market trends up. Okay, so let me show you. This picture put into this webinar material is not the best one. Better opportunities can be found. I would draw this from this high peak before the drop from this point. Although for the sake of the example, we can rely on this picture. That's not a problem. So what you do, you use the Fibonacci retracement tool. In the MetaTrader 4, it's really easy to find. If you go to indicators, you'll find the Fibonacci category really easily there. Okay. So you start drawing the Fibonacci retracement tool from prior to the drop to the very low point of the drop. As you can see, this third candle here at the bottom, this is the low point of the drop. And these levels then, these retracement levels manifest onto the chart. On this one, it shows as 0.236, but actually it is 23.6%, 38.2%, 50%, 61.8%, and 100% here. Okay. It's really easy to read. So what you would be doing here, that after you see some exhaustion setting in after the major drop, you can start looking for call opportunities going along. Okay. So based on this example, my entry would be after this green candle closes. Okay. This is a bit of a tricky one because these exhaustion candles are relatively high in magnitude. So as you can see, it's a really heavy doji here. The wicks extend over the previous candle's wicks already. So it's a bit of a tricky situation here, but I will start looking for long opportunities after this candle closes. And in this situation, the price, I mean, it retraced to the very first retracement level 3 times during those 3 hours, which is a bit unusual, but this shows how many times you could actually have traded this. Okay, depending on your risk appetite, you could have already entered long after this this red candle closed here, and you could have profited from this trade. When it came back down, you could have profited from this trade as well, although this would have been really risky to expose yourself to this upside trade 2 times. Because if the news was really significant, it's really likely that the price will retrace or retest the very low point of the drop again within the next few hours. Okay. So this is really straightforward. At the very first level, it is a bit riskier. You can also, if you want to be more confident, or if you have a larger risk appetite, you can try to get a bit more or squeeze more out of this trade. In some cases, the price even retraces to the 38.2% level. But this already depends completely on the situation. What was the news affecting the market? And then you should be analyzing the overall market condition, and of course the previous support resistance levels come into play on a larger scale as well. Okay, so any of these kind of large movements, I would recommend looking out, zooming out to 4-hour markets, 4-hour charts, and daily charts as well, to seek for any potential nearby support resistance levels that might be either bouncing the price away or just drawing them near for a retest. Okay, so it's really straightforward. Vice versa, if we would be having an upward market, you would be drawing the Fibonacci retracement tool from the low point before the rise to the very high peak after the rise. So if you start seeing some exhaustion setting in, then you can go short to the very first retracement level and then trade it there. Now there is one more way how you can enter the trade if you're not comfortable trading against the trend to the very first or the second retracement level. You can trade it along with the trend direction after the price has moved or retraced to the very first retracement level. This is also an option. So on this occasion, I would be start looking for short opportunities around this level here, just after it has passed the very first retracement line. Okay. So again, this example, it generates several opportunities in a row. This usually doesn't happen. It's really unlikely. But just above this very first retracement line, you can go short. And you don't even have to set your take profit to the very low point of the drop. You can just set it halfway. Halfway is totally fine. And set your take profit to the next retracement level. I'm sorry, your stop loss to the next retracement level, just above it a little bit. So this how I would assign my take profit and stop loss levels based on this really simple and straightforward approach to using this Fibonacci retracement tool and then trading it. Okay, on this webinar today, as I am in a completely different location, I don't have the opportunity to open up the MetaTrader 4 this time to actually draw some Fibonacci retracement tools on the live chart. We'll definitely do that next time. So if you have time to attend the next webinar, we'll get more into detail how to draw the Fibonacci retracement tool in MetaTrader 4, where to find it, and how to use it in different scenarios. So this one was uh, a bit shorter than usual, a bit straightforward. So if anything remained unclear, please don't hesitate to ask in the questions section. I'll do my best to answer them. Okay, any questions coming in? Okay, well, it seems that there are no questions coming in today, but yeah, again, it was really straightforward. Actually, I have one question. Great, one moment. Okay, let me just widen it up a bit so I can see it better. Okay, Maputi is asking, what determines how long the trade should be using that strategy? That's a good question. I tend to let the trade run until the trade hits my take profit or stop loss, because the stop loss and the take profit levels are not too far away. And of course, it really depends on how large the movement has been prior to the prior to your trading opportunity. However, if you really want to set a timed trade exit, then I would say no more than 3-4 hours. Okay, Lewis is asking, is there a way how to know how strong the retracement can be based on the Fibonacci retracement tool? And there is really no way to determine how significant the retracement can be, to what level it will retrace. But one thing to keep in mind that as this Fibonacci sequence, it appears all over us and in nature, and we are part of nature. So our trading decisions can also be um, the Fibonacci sequence applies to our trade decisions as well, believe it or not, whether you intentionally apply that logic or not. So it comes unconsciously, okay? So if you draw the Fibonacci retracement tool onto a chart, then you will at one point you will realize that at least even the very first retracement level, it's acting like a magnet. If you technically analyze the price and the chart movements, you will start believing that the price should significantly start moving downwards again after a large drop. But this very first retracement level is like a magnet pulling the price towards itself. And it works, and it works like that. It's really straightforward, and yeah, this Fibonacci sequence, it is really mystical. One thing I did not really explain is how to perhaps trade it during a ranging market. Essentially, what you can do, you can start drawing the Fibonacci retracement tool from the top side of the range to the very low point of a certain price range, and simply use these Fibonacci retracement lines as support and resistance levels. Okay, if you are aware of how support and resistance levels work, then you can simply apply the support and resistance trading logic here in this Fibonacci retracement patterns. Just treat those retracement levels as standard support and resistance levels in a ranging market. Last call for questions. Okay. Okay, Maputsi is asking, can the strategy be copied in an automatic way, I guess? Essentially, you're talking about automation of that Fibonacci retracement patterns and the strategy. Sure, you can automate it, but as with any fundamental trading strategies or logics based on a single technical indicator, does not really work longer term, as the market conditions will change really rapidly and always have. So letting this type of robot run for an extensive amount of time, you can simply end up in balance because the win rate is around 50%, and your take profit and stop loss levels would also be 1-to-1. Okay, so you should be using this strategy manually, determine if the market conditions really favor you trading either against the trend to the very first retracement level or along with the trend from the very first retracement level. So it all depends on the market conditions and if they are suitable for this type of approach. I hope I answered your question. Okay, thanks. Okay, Luis is asking, how do we know when the trend is going to retrace? After a significant price drop, as you can see, there are a lot of red candles in a row. So the price has been dropping significantly for the past several hours, okay? But now you see some exhaustion setting, and you see these near dojis and really, really large wicks. That already indicates that that the price has reached a level where extreme indecision has set in. So most likely we are also dealing with some kind of a previous significant support level for the price based on past price action. So if you see exhaustion setting in, if you start seeing these reversal candles, then that is an indication that you might experience retracement to the very first Fibonacci retracement level at least. Okay, so this is where you should be seeking for trade opportunities. You don't necessarily have to know each and every reversal candlestick pattern. You can simply rely on visual analysis, how the volume is around those levels and what is causing these really high wicks on both sides of the candle. Okay. All right, as I don't see any additional questions coming in, then I'll be wrapping it up for today. Thank you for attending. Next week, I'm sure we can get the MetaTrader 4 up and running as well, just for me to show you a few things on the actual live trading environment, just to give you a better insight of the actual topic of the webinar. Okay. So yeah, thanks for attending. I hope you all have a good day and remain profitable. Take care. Thanks, Carlos.